Good morning, everybody. This is Jonathan with Alpha Watch. I got my good friend Dave Gregory all the way from beautiful Pennsylvania. Dave, how goes it this morning?
Not bad. How are you?
Yeah, well, I live in Omaha, so even asking the question, it's the perfect place to live, raise a family, all that stuff. So we're crushing it to get the day started. Well, hey, Dave, I got to ask a couple things right off the bat. We live in this real estate oriented space. I own real estate, my house. You own real estate, your house. You might even have properties or stuff. But when I look at the space and I look at servicers and companies that are involved, I see increasing book values, but stock prices are not keeping up. Stock prices are even going down for some of these entities like a Rhythm Financial, Redwood Trust, MFA. Help me understand, why would a book value increase but a stock price go down?
Yeah, I mean, so it's something we've talked a lot about recently, in the context of mortgage REITs and servicers. Certain publicly traded mortgage companies and REITs, they own mortgage servicing rights and other, interest rate hedges, which have actually enabled them to grow book value this year. And so for mortgage servicing rights, basically because mortgage refis are falling, close to zero. People aren't refining their mortgage anymore because of how high rates have gotten. Basically, if you own the right to service these mortgages, you're generating a longer stream of fees because that stream is going to last a longer period of time, and it's an actual asset that's worth more in the market. So yeah, I mean, despite higher book values for certain names, I mean, stocks have declined in price, materially, I would say, kind of across the board. I mean, obviously part of this is just the fact that the market's down, for everything, and, stocks and bonds are down. But we think the primary driver of a lot of the heavy selling that's happened in the market, which, call it from mid-August to mid-October, is when you saw a lot of selling of kind of mortgage-related equities. And we think a lot of that is really, being, driven by the fact that investors think that this is 2020 all over again, and they think that there's, imminent funding issues and, potential forced selling, in the market. You have to remember that non-bank mortgage companies, they use leverage, similar to just how banks operate, right? And so, banks have been less focused on mortgages since the '08 crisis because of, increased regulations. And so that's opened the door to, a lot of these non-bank originators and REITs to really gain market share. And so, we think a lot of the selling, has been by retail investors that own ETFs that, have sold the ETFs. These are investors that basically, are maybe in it for the dividend yields, but don't have a really good idea of, of the underlying balance sheets of these companies. And so if you think about the balance sheet, on the asset side, you have, residential mortgages, which have, pretty low loan to value ratios, definitely relative to, where we were in 2007, 2008. And consumers have strong balance sheets. So if you think about it, when you own a mortgage loan or a mortgage bond, you don't need massive home price appreciation. You just want to get paid back, right? So we think it's, fundamentally on the asset side, things are stable. On the liability side, we've talked about it, but leverage is much lower than where we were in 2020. Many of these companies really learned lessons that you can't use a lot of short-term leverage against, assets that can be, pretty volatile. And so if you look at where we are now, it's almost impossible for these companies to get into the types of funding issues that they saw in 2020 because they're borrowing less and they're borrowing much longer term. They're using the securitization market, and so if you think about it, it's really a fundamental misunderstanding, I think, in the market, by primarily retail investors that have just sort of sold and ask questions later. Let's not take the time to actually dig into the balance sheets, both on the assets and the liability sides of these companies.
Well, you said something, two things interesting that I wanted to highlight. I just thought I saw a report the other day that said the average mortgage rate U.S. homeowner has today is 3.3%. That's the
Yeah.
average. And rates today are 7.1, 7.2. It kind of depends where you are. It seems to me there's been a shift in the homeowner balance sheet to that mortgage is now the asset and your house is kind of the liability. So that
Mhm.
seems like a big shift from where my dad bought his house in the 80s, 18% rate. That's a big shift.
Yeah.
But you also mentioned another thing about leverage and these banks and these REITs using leverage, even though they use it more short term than long term. Are you concerned about mortgage REITs? Is that something that you worry about? Granted, they're using different leverage. They're still leveraged. What are the risks and opportunities with these mortgage REITs?
Yeah, I mean, I think it's, mortgage REITs have gotten hurt this year. I mean, they got pummeled in 2020.
Yeah.
And a lot of them have gotten hurt, so far this year. So if you think back to 2020, there was a good reason for mortgage REITs to get pummeled at that point. It's part of the reason why we didn't really like them that much in 2019 and early 2020. They were using just too much leverage, and they were borrowing through the repo market against non-agency RMBS, which is mark to market and it's short term in nature. So if you hit a period where there's a lot of volatility, which we all know, it happens from time to time, then that credit line can basically get pulled out from under you, and you're forced to go out and sell those bonds into a market where you don't want to be selling bonds. And so we saw those risks at that time. And if you look at kind of where we are now, there's virtually no mark-to-market leverage against non-agency RMBS. I mean, there's a little bit, but it's so much less than where we were. And they've really learned these lessons, right? They pushed out their leverage to be much longer term, much less mark-to-market, more non-recourse. And so, the punishment that the space has experienced, so far this year, we think is not justified. And it's really just a matter of time for the market to kind of wake up to the fundamentals. Speaking of the fundamentals, we basically just got the third quarter earnings on, I think every mortgage REIT at this point. And it really validated, how we look at this stuff, which is, any of these guys that have big positions in mortgage servicing rights have actually increased their book value again. And, non-agency mortgage REITs in general have not had any material funding issues. There's been some book value declines for some of the names, but it's been much less relative to the decline in the stock prices. The other big thing is if you take the time to listen to some of these earnings calls, like you mentioned, MFA and Redwood, they're buying back stock, right?
Wow.
And so when your stock trades at 50, 60, 70% of the tangible book value, then one of the best investments they can make is in their own common shares. And to some extent, their corporate debt, which is also trading at deeply discounted levels. So all of this is very accretive for shareholders. It's a good thing. So no concerns there. I think if you look at the commercial real estate side of the equation, that's where we actually do see fundamental concerns. And so things like commercial mortgage REITs and REITs that own commercial real estate properties, higher rates not only increase your financing costs, but they also push up cap rates, right? And so a cap rate is essentially your net operating income divided by the property value. So if the market says this should trade at now an 8% cap rate instead of a 5% cap rate, then if you own that property, you either have to raise rents or the value of the property has to go lower. And, we see some pretty major headwinds to raising rents, especially for properties like lower quality office space and retail. So that's a part of the market that we think, you basically should avoid. Listen, in the short term, it's anybody's guess. I mean, but, it's hard to predict short-term price action. but we're really, really focused on fundamentals, and ultimately fundamentals will drive total returns. And so based on current dividend yields for a lot of these residential mortgage REITs, and the fact that some of them are still trading, on the servicer side especially, are still trading at, 50, 60% of tangible book value, this is a part of the market on the residential side where you can make a lot of money over the next year or two.
Well, I've always heard you say we love real estate because there's always pockets of inefficiency.
Yeah.
I think you highlighted a couple right there. Well, hey, let's get to the wind up part. Time to end. This has been an awesome conversation. 30 seconds. We're in the elevator on our way up to the 10th floor of the tallest building in Omaha, Nebraska. Give us the elevator pitch, the wind up about the price to book value.
Yeah, I mean, I think we focus a lot on price to book. This is a massive opportunity right now to invest in companies that are trading at, 20, 30, 40, 50% discounts to tangible book value. So if you're going to buy something right now, buy it at a discount to the sum of the parts, right? And so this is a chance right now to not only buy high dividend yields, but it's going in and buying something at a discount to what the underlying assets minus the liabilities are worth today. The market's volatile. Nobody knows what's going to happen in the short term, but you can sleep well at night knowing that you're buying at a discount to the sum of the parts for a fundamentally sound asset.
Nice. Well, I like sleeping well at night, and so does everybody else. Dave, thanks, man. You're the best. Appreciate you hopping on at short notice.
Yeah.
Everybody, feel free to see this. It'll be on alphawatch.blog soon. Register, subscribe, and we'll talk to everyone later. Thank you.
See you later, John.